Good morning and warm welcome to you all. I'm Vaibhav, your host for today. Let's continue with our 142nd virtual webinar with the topic Startup Valuation. It shall be taken by Ms. Nirmala Soni ma'am. She shall be covering who can be registered valuer, what is startup and its ecosystem, valuation approaches and methods, followed by question and answer session. Let's quickly go through the agenda. Virtual inauguration by Dr. Sundar Kataria, invoking the blessing of deity, chanting of Gayatri Mantra, introduction of speaker, presentation by Ms. Nirmala Soni, question and answer session, and last closing session. A brief introduction of Dr. Sundar Kataria. Sadgun Sangh conceived and led by Dr. Sundar Kataria, driven with a mission to elevate the quality, safety, and environmental awareness levels of industry. Sadgun Sangh is a series of educative, informative events aiming to illuminate professionals on possible solutions to current issues of industry and economy. Let's know more about Dr. Kataria. Designation and organization, Chairman and Managing Director, International Certification Services Private Limited. His academic qualification, Mechanical Engineer AMIE, Honorary Doctorate, Business Management. Dr. Kataria has experience in nuclear RAPP. He started his career in building India's first nuclear power plant at Bata, Kota, Rajasthan. Oil and gas, EIL. He contributed in developing India's first oil and gas field at Bombay High since its inception. DNV. He was head of industry and offshore development with DNV for 2 decades. ICS. He is the founder of first Indian conformity assessment and inspection body known as International Certification Services Private Limited, which is a provider of total quality solution under single umbrella with a wide spectrum of services. His achievements and awards: Lifetime Achievement Award of NES Corcor, received several national and international awards. So now I request Dr. Kataria to please virtually inaugurate the session.
शुभं कुरु त्वं कल्याणम् आरोग्यं धनसम्पदः शत्रुबुद्धिविनाशाय दीपज्योतिर्नमोऽस्तु ते दीपज्योतिर्नमोऽस्तु ते शुभं कुरु त्वं कल्याणम् आरोग्यं धनसम्पदः शुभं कुरु त्वं कल्याणम् आरोग्यं धनसम्पदः.
Please join us for the recitation of the Gayatri Mantra. Introduction of our today's keynote speaker, Ms. Nirmala Soni. Designation and organization, CA, Registered Valuer, SFA, and Social Auditor. Her academic qualification, FCA, Registered Valuer with IBBI, Social Auditor, and Chartered Accountant. her area of specialization and experience. Mentor with Startup India Portal, Satna Incubation Center, Jabalpur, Incubation Center and Spark, Sagar Startup Park, MP Startup Center. Visiting faculty with RVO, Career Counselor with ICAI. Awards and achievements. Top 50 Remarkable Woman Award 2023 presented by Diva Plant Magazine. The Real Superwoman Award 2013 presented by Forever Star India. Certificate of Appreciation received from RVO, IBBI. India Book of Records received from Collector of Satna. Please welcome Miss Nirmala ma'am. Over to you, ma'am.
Thank you, Weber, for the introduction. Let me share my screen first.
Yes.
Whether my screen is visible to all?
Yes, ma'am.
Okay. So, first of all, good morning. So our today's topic is startup valuation. But before going to with the topic startup valuation, let me introduce first. Since startup valuation is done by the register valuer, so you should know the who is the register valuer, who can be the register valuer, and what is the meaning of the startup, how the valuation approaches are there, and we will be covering various topics today, like who can be the register valuer, what is the asset class, what is valuation approaches, what is startup, example of startups, and startup valuation methods with examples. So all will be discovering with today. So first of all, who is the register valuer? So register valuer can be a person or a organization. Like if 2-3 persons register valuer, they form a company or a partnership firm. So they can be a register valuer, and they should be registered with the IBBI as a valuer. Since the valuation, this field was very much was not proper earlier. So new concept was introduced by Companies Act 2013 regarding this register valuer. Since because the valuation profession should be proper, you should give the fair picture to all the stakeholders. Like various stakeholders are involved in the financial statements of the organization, like a government, bankers, investors. So they should be have the authenticity of the valuation report. So the new concept was introduced by the Companies Act 2013, that is register value. So in Companies Act, section 247 deals with the register value. It specifies all the who can be the register value, qualification, disqualification, eligibility, all the professional ethics, what should be the professional ethics of the register value. All this have is there in section 247 of the Companies Act. If anyone has any doubts, anything, they can raise their hands or ask the questions, or in between also. So who can be the register value? Section 247 was introduced, came into force in October 18, 2017. It deals with the company's register valuer and valuation rules 2017. So valuation is required to be made in respect of any property. So there can be any property like land and building, plant and machinery, stock, shares, debentures, securities. Securities can be like a debenture, convertible preference shares, convertible bonds, or goodwill, or any other asset or net worth of the company. So this valuation is done by the register valuer. Only register valuer is eligible to do the registration of this. So and a register valuer should be a member of the RVO. RVO stands for the Register Valuer Organization. So there are, in India as on date, there are 16 register valuer organization. So, but there are 3 types of asset class we would be discussing later on. So 16 register valuer organizations. Name of these are like this: And some deals with all the three asset class, or some deals with the specific asset class. Like ICA deals with the only securities and financial assets, but others deals with the if we take the example of this uh, IVO Register Valuer Foundation, it deals with all the three classes of assets: land and building, plant and machinery, and securities and financial assets. So anyone who want to be a register valuer, first they have to be registered with this register valuer organization. They should uh, they should be eligible for the conduct. So they should be eligible exam. Like asset class, there are two types of asset class, technical and financial. So in technical, there are two sub parts like land and building and plant and machinery. So basically, there are three types of assets, asset class: land and building, plant and machinery, and financial and securities analysis. So for land and building, the eligible person is a civil engineer. Plant and machinery, eligible person is mechanical or electrical engineer. So the person who has done the mechanical or electrical engineer can do the valuation of a plant and machinery. And CA, CS, MBA finance, CMA, all they can do the valuation of securities and financial assets. Since I am a CA, I have done the register valuer of securities and financial assets, SFA. In short, it is called SFA. I can do the valuation of the business startup valuations. So one should be for the value for this, if you are eligible, like I am a CA. So first, for doing valuation course, I should be registered with the RVO. Go for the training. One should go for the training of 50 hours training. Then they can appear for the exam. After training, they will be having a certificate of participation, and they can be eligible for the exam. And after the exam, they will, if they clear the exam, they have to register with the RVO. They through RVO, they are the member of IBBI. So the supreme authority for this is IBBI. So the main hierarchy would be IBBI through RVO, and then we are the member of the RVO, IBBI through RVO. So all the regulations would be all the regulation rules and regulation we have to be followed by the IBBI. And even the RVO take the notes of the all the register valuers. They provide the guidelines. They take the month quarterly reviews of the whatever the reports and everything. So the if any we have any doubts or any complaints, or we have anything, we have to communicate that to the RVO. They will communicate to the IBBI authority. So the intermediary will be the RVO. So this is all about the RV register value. And one can go like there is a myth that since I am a CA, so when I've started this, the everyone told me to do the RVO course from ICAI RVO, but the member can do the register value course by any RVO. Since I have selected TVI as a my RVO, so one can do the register value course as per his or her choice, or based on the location, uh, whether there is a physical classes. Normally there are only online classes are there. Even I am the faculty with a 2 RVO, so I take the online classes of that. So one can go for the online classes only. So it would be better that any person from Chennai or anyone can go for the evaluation course. And after 50 hours of training, they can be eligible for the exams. And exams are like 2 hours exam is there, and it is an online exam. All multiple MCQs are there, multiple choice questions are there, and 60% passing marks is there, and negative marking is there. Mostly the negative marking is there because of this. The passing percentage is very limited. But in future, there will be much scope for the register valuer courses because the valuation rule, valuation core. Valuation Act is under the Parliament, so there will be enough scope for the valuer for the valuation. Like in FEMA, right now the reports are required by the merchant bankers and chartered accountants. But in future, it can be only register value. So this is all about the register value. So we are moving to next concept like valuation. What is valuation? So valuation is related to a specific point in time. So timing is very important in the valuation. Like if we are going for the IPO, so the before IPO, what would be the value of shares? So what would be the pricing price band for which we should go for the valuation? Or so timing is very important. As on date, what will be the value of the property is very important. So what is being valued is very important. Like whether we are valuing any plant and machinery, or land and building, or any securities like shares, whether the and why it is being valued. Like shares, if it is valued, whether is shares is valued for the buyback of shares, right issue of shares, or whether it is for the IPO. So purpose of the valuation is very much important. One should know the purpose, because of based on the purpose, the valuation may differ person to person. Like a startup is valued, whether the startup is valued for only to know the what will be the valuation of our startup, or whether it is valued for the funding purpose. So what is to be valued and why it is being valued is very important. So one should know the purpose of the valuation. I know mostly the valuation is based on the concept like going concern. Like in financial assets, financial statement also, we prepare the financial statement as a, there is a fundamental principle that a going concern concept have to be followed while preparing the financial statement. So in valuation also, we prepare the valuation based on this concept, like going concern. Since we think, we accept that the firm will be in a growth stage, and it will be continue in future also. So going concept is followed in valuation. And there can be a valuation in like in liquidation. Suppose any company or any business is into in liquidation, then also the valuation report may be required, because whether they want to sell whether they want to sell this plant, means overall factory or business to any other person, any other business, or whether they want to merge with other business. So what should be the value? What should be the exchange ratio for this? So one based on the valuation, we can derive at the exchange ratio. What can be the exchange ratio? Like in merger and acquisition, what should be the exchange ratio? Suppose I give 2 shares of my company, what will be I be getting in future? So it is very important. Premium for control. Suppose in merger and acquisition, like if I want to take over any company, so what would be the valuation of that company? So to have the control, like to eliminate the competition, various companies take over the companies, or merge with the companies to have a wider scope of a business. So efficiency is increases because of that. Synergy effect is there. Suppose one company is very good in financial matters and one company is very good in technical matters, or IT department. So if they are merged together, they have very synergy effect of that. So it is very important for the valuation. So basically there are valuation approach I will be dealing afterwards. So valuation is nothing but the process of appraisal or determination of value of certain assets. Asset can be a tangible or intangible, securities, liabilities, or any specific business as a going concern. So anything which any asset which have a which gives you any set is a utility. That utility is a value for you. Suppose if you're reading a book, and if your exam is there, so what is the value of book? The value of book will be more to you. So that will be the valuation. Valuation is differ from the pricing. The price of the product may differ. The price of the product is a objective term, but valuation is a subjective term. So whatever the benefit which you derive from that book is a valuation of that book. So business valuation requires a working knowledge of variety of factors, professional judgment and experience. Like a register valuer, one should be a register valuer. We should have the proper professional experience for the valuation. So valuation discipline is neither a science or an art. It is a craft, a skill that one learns by doing it. So when you get the actual assignment, or you know how to do that assignment, because in exams, normally in exams everything is given like beta, or what would be the market rates, risk free rate. So, but while doing the valuation, actually valuation, one should have to derive all these things like beta. If we are doing a valuation of shares of a IT company, we have to derive the beta from the IT sector. What is the beta for the IT sector? What are the valuation? So one have to derive everything. So by doing it, we learn a lot. So, and valuation is a quantity and qualitative process of determining the fair value of an asset and liability. So there are valuation approaches. Basically, there are three approaches for the valuation: income approach, cost approach, and market approach. So valuation is quantitative process of fair value, determining the fair value. Company can be valued on its own absolute basis or on a relative basis. Absolute basis means when the company's own data, like financial of the companies and projections of the companies, management decision of the companies, when the valuation is done based on the own company's data, it is called as absolute valuation. And when the relative valuation means when the valuation is done by uh, taking the valuation of other companies, other data of the other companies. Like if we are valuing any auto sector company, and we take the what is the market price of the autos, like Maruti, Hyundai, shares of these companies, and we take average of these companies, and then we derive at the valuation of our company, then it is called as a relative valuation. So it differs. If we are dealing with our own financial data, then it is absolute valuation. If we derive valuation based on the other company's data, then it is called as a relative valuation. So there are various methods and techniques for arriving. Like I did, there are three approaches basically, but in three approaches there are various methods for the valuation, like market approach, income approach, and cost approach. And all these three approaches are based on the principles, economic principles of price equilibrium, anticipation of benefit, and substitution. One can use any one approach, or they can do the valuation based on the one or two approaches. Like I suppose if the company is very good in the value, very good projection of the company is very good, they can go for the income approach. But the company is going into liquidation, they will not be have any future income, so there will be no projections of the income. So one can go for the cost approach. Cost approach basically is done by the normally whatever the assets and liabilities they are having as on date of the organization, and what will be the realizable value of that asset will be the cost approach. So for the liquidation part, one can go for the cost approach. But if the company has a good future, they is earning is good, they are in the growth stage, then they can go for the income approach. But if the company is very new in the market, and there is no right now we cannot predict any future of the company with certainty, that whether this company will grow or not grow, how much they will be earning in future or not. So if we are not in a position to predict what will be the future, one can go use for the market approach also. So if so in initial stage, one can go for the market approach, but in growth stage, one can go for the market approach and income approach. Both the approach can be possible, or one can only go for the income approach. If the projection are very much accurate, one valuer can go with one approach also. but if he finds that the valuation is not that much accurate, one can use a income plus market, and he can specify the weightage to both the approaches, that I giving 80% to the income approach, 20% to the market approach, because there are the projections, there maybe it is not certain that, so one can go for the two approaches. It is based on the assumptions of the register value. So valuation differs from the person to person. Like if I do the valuation, the price will be, suppose I get a price of 43 per share. But if any other valuer is doing, he get the price of 48 per share. So valuation differ from person to person because it is based on the assumption. Whatever I have assumed, he is not assumed like that. I have taken the risk factor as a more, because like in case of a startup, there is a more risk. So I've discounted at a higher rate. But in other cases, he has not taken that much. So basically, there are normally there are three approaches, but in three approaches there are various methods. Like in cost approach, there is a net asset value, liquidation value. Income approach, there is a discounted cash flow method, yield method, royalty relief method, contribution excess earning method, market approach, market price method, comparable companies multiple method, transaction method. So generally combination of methods are preferred, or approaches are not exclusive but complement each other. So it depends upon what is what is the purpose, what asset is being valued, and what is the purpose of valuation. So based on the purpose, one can decide whether they can go for the income approach, cost approach, or market approach. Then we would be dealing with the what is startup. Basically, if we are doing the startup valuation, we should know what is a startup. So startup is basically the young ideas. Basically, if any new product or new services are introduced in the market to replace or to make the market to make a possible to solve the society problems, then it is called as a startup. So mains to startup to succeed, the main ingredients are people, product, and process. Normally, so there should be a idea. So people is important. Management is very important. So there should be a new product, and or there can be a unique process for that product. Like if there are like society problems, like there are various startups on waste managements, or there are various startups on agri-tech, fintech. So like agri-tech, agriculture is a very normal, but if you introduce a technology with agriculture, then it is called as agri-tech startup. So that the process of the agriculture is streamlined, and the product can be available to a number of persons. And for the startup, there should be a unique idea. First of all, there should be innovation. Now there should be a scalable business. That it should not be concentrated to one city or one state. It should be one should think that the startup can grow in national level, or it can be go for the international level also. So if we take the like example of a biojuice or a Zomato, they like biojuice, there was it is very new concept of technology. All so since there was no like this platform available earlier, so biojuice was the first to introduce all this concept of online training, uh, giving a platform for the all the uh, make learning as a fun for the kids, and to understand the concept very well. So normally there are three stages in the startups: early stage, growth stage, and matured. Early stage means the only idea is there, that I will do this business, only idea is there, but the product is launched, one has made the product, but In growth stage, there is a revenue generation. This startup has worked for at least 2 to 3 years, and they are started earning. And in mature stage, the startup has already achieved so much of business, they can go for the IPO also. Like Zomato, they started in 2008, and soon in 2008 they have just started the business, this startup. And in 2010 they full-fledged worked for this startup. So they both, the founder and co-founder, left their jobs, and they concentrated on this startup only. So they have taken the there was a growth stage, like they have increased their scalable business, but there was no profit as such. Right now, in after 10 to 13 years, they have earned the profit, and they have gone for the and they also gone for the IPO, since there the product was there, the idea was very unique. They were the first, and if the any person, there is a unique idea, and you are the first person in that field, you obviously get the benefit of that. Like Swiggy was the second. They always have to face the competition from the Zomato. If there is a same unique idea, if same line of business is there, but if there is a new idea, then obviously you get the benefit. So for the startup as such, there is no definition given in any where, but since there is no act available as such for the startups, if we go for the partnership, there is a partnership act. Companies, there is a Companies Act 2013, but for the startups there is no such act available right now. So but only the one definition is given in the Startup India portal by DPIIT. So one guy for the startup who can be an eligible startup. So the eligible startup can be only a private limited company or registered partnership firm, limited liability partnership firm, LLP. So only private limited company or LLP can be a startup, like a individual or HUF or cooperative society, public companies, foreign companies, they are not considered as startups. So if you are a suppose you have working on an individual basis, if you have an idea or so you register, first of all you register your startup as a company or a LLP. If you register as a company or LLP, then you can get the benefit of a DPIIT. You can register your startup as a DPIIT registered, and if the startup is registered with the DPIIT, then there are much benefit, like they can go for the seed funding. Seed funding means they can eligible for various funds, or like grants available for the startup by the government. Various central and state schemes are there for the startups. So there for startup there is a private limited company and a registered LLP. This company should not be formed by splitting or restructuring an already existing business. I have already started a business, since like I am doing a practice right now, and after 2 to 3 years I start that I register my this as a company, or that like other companies, there are clear tax or any type of this. I introduce that this is my startup. Cannot be a startup. There should be a new business, and which it should not be formed by restructuring an already existing business. And there should be a scalable business. The startup, the main feature of the startup is there should be employment generation. It give the generation of employment to various persons at various cities or various stages, like skilled, unskilled, or so all the categories of a person should be made available jobs, and the startup is created for the wealth creation also. So the period of existence should not be 10 years. Like if any startup is there which is formed on 2013, so it is already crossed 10 years. But if any startup is formed in 2000, then only 3 years of business is there. So it is less than 10 years. So they can be an eligible startup. Turnover of the business should not cross 100 crores in any of the financial year. Then they are called as a startup. So to grow startup, there is the main feature is of a ecosystem. So ecosystem can be since India has a third ecosystem, largest ecosystem of startup in the world. Ecosystem means whatever the persons or organization which are helping for the startup is called as a ecosystem. Like there are mentors, physical or virtual. Like I'm a mentor with various incubator centers. Incubator centers, they provide all the facilities to the startup. Since if any person is only having an idea, but he is not having a space for the business, he is not cannot invest to take any office, or he cannot invest in purchasing the laptop or printers, or he cannot go for have a fund for the marketing of the product. They can approach the incubator center nearby location. Like if any startup is in Gujarat, they can approach Atal Incubator Center for that. Uh, they can join this Atal Incubator Center. They will provide all the facilities. Like they would be getting a space, they would be getting a furniture, they would be getting a laptop, printers. They would be also getting the mentoring. Mentoring means if they are not in good in IT, they would be mentored by the IT mentors. If they are not good in finance, they would be mentored by finance. Like I'm a finance person, CA, or a valuation person. So I'm mentor regarding that. What are the benefits of the company registration? What are the formalities to be followed by the startup? But what are the various type of registration required for the startup, like Udyam registration, DPI registration. They can also go for the angel in taxation benefit. They can be benefit for the angel taxations. So incubator centers help a lot to startup to grow, since all the fundings can be available. Since the person is very good, they have a very good idea, but they don't have the funds right now. So these incubator centers provide all the facilities at a very nominal rate or free of charge. Like in Satna, there is an incubator center like Satna Incubator Center. I'm a mentor there. Right now they provide they charge nothing, and there are various type of mentors are available which are very good in suppose on IT or marketing. Even their websites are startup websites are done by this incubator centers. They guide. Even the toll free numbers are available. They get them toll free numbers freely available for them, and even they are mentored by the various who are already a very good entrepreneur. So all they get the benefit of this mentorship from the incubator centers. So banks are the also ecosystem, government. So all this helps helps for the startup to scale their business from the initial stage. So it is very important. One should know where to approach and how to approach. So understanding the ecosystem benefits for the startups, and they can easily uh, boom their business, and they can also help the economy by generating job locally. like if I take if I give an example, like in Sadna, that there is a startup called as a Tutor Buddies. It gives employment to all the females, whoever, or all the retired persons, or all the students who are very much interested in teaching field. They can be the tutors of that, and they will be providing these tutors to the all the persons who are registered, all the parents who are registered with this Tutor Buddies. So where there are various type of this facilities can be provided by the, so employment generation is the main motto of the startup. So it should give the employment to more and more persons. So ecosystem can be a big companies, universities, funding organizations. Since there are various type of organizations are there, angel investors, venture capitalists, service providers, research organizations. All these form parts of the ecosystem. So basic, if we take to example like a pharma easy. Pharma is a online pharmacy. Everyone knows her, and which is specialized in OTC products. And it deals with the, it has a valuation of around 350 million, and it has eliminated competition from the Reliance, Geo, Netmates, and Flipkart, Amazon. So all these have merged in Pharma Easy. So this is a means this platform provides all the facilities, like all the medicines you can get at a discounted price. Various offers are there, and it is available at your home. And even like a Zomato, if you don't want to go anywhere, you can easily order your product, your whatever the food requirement is there, you order your food, and based on and if there are various offers available. So without wasting much time on transportation, your time on reaching that place, and even at a less price, that various offers are there. So you get all this at a discounted price. So when will we go with this startup only, like Mishu? There are various products are available out Mishu. The ladies or any persons who are they cannot go outside. They can easily earn from the Mishu app. So startup companies, basically funding is a main in the startups, like normally the startups. So for the valuation part, the startups are basically divided into two types of pre-revenue generation and post-revenue generation. Normally, the first stage in the startup is a bootstrap. Normally, if you have seen a Shark Tank, they are normally asked if any founder or co-founders are there in the they present their stars, whether it is a your startup is a bootstrap boots, or it is a you have taken funds from anywhere. So bootstrap is nothing but the funds own funds. Bootstrap is own funds or funds available from family and friends. Suppose you have started your business with your own funds, or you get funds from your family or any friends, then it is called as a bootstrap fund, bootstrap startup. That your own money is invested in this business. Then it is a bootstrap fund. So bootstrap is nothing but the term used for the process of using one existing resources such as personal saving, personal computing equipments, or garage space. You suppose you have a garage space or any, and you start any business there, or you have a means all you are very good in IT, you start any business from this, then you are using your own resources, then it is called as a bootstrap. Then the no, if to business to grow, then you require extra funds. So there are angel investors, venture capitalists, they invest in the startups. And there are incubation centers also. They provide or the central and state schemes are also available for the startups because the government is very much interested in growing the startups. So they there are various schemes available like MSME hackathon schemes are there, or even seed funding. Seed funding means or seed to grow means like startup to grow, they provide the funds. So they funds provide the funds as a grant that no they it is not to be returned to the government, or they can provide the in the form of the uh, equity or loans or this type of. Even angel investors or venture capitalists provide the funds in the form of equity. They take some equity, so the startup has to dilute their equity, or they can take the funds as a loan. And a mature startup can go for the IPO. Suppose there is a very good growth in the business, then they can go for the IPO also. Slide number 16. This is slide number 16. One has asked. Slide number 16 is for the ecosystem of the startup. So ecosystem can be a and investor, mentor, advisor, or there can be a support organization, big companies, universities, like various universities like in Satna, AKS University. So they also have their incubation centers, or there are various like IIT Kanpur. They also have their incubation centers. So various universities also, because in IIT Kanpur there are various type of engineers or technical persons are there which can develop any new product or a new technology which can be unique for the startup, which can be a unique startup, like if any drone or any type of this can be made by them. Startup company valuations. Since startup company valuations, there is a limited history because the startup, suppose if the startup is new, very new, then there will not be any history. If the innovation is taking place at a first time, then there cannot be any benchmark set by any previous. So there is a limited history. Like if we are doing a valuation of Zomato, there was no such business earlier. But if we are doing valuation of Swiggy, then we have a benchmark of Zomato. So the same line of business or same line of a startup is already there. So one can easily have the understanding of the Zomato and Swiggy business, so they can do the valuation. But if there is a for the Zomato, there was a limited or no history was there, because it was a unique idea. So no one was very much sure whether this startup will work in future or not. So there in startup there is mostly the challenge is to raise the funds. So because if there is a new idea or new business, there is no surety whether this startup will be in very good in future or not. So one is not sure in investing such type of business. Suppose if you want, if Swiggy go for the IPO, you will invest for the Swiggy IPO, because Zomato IPO is also very good. Zomato has started earning also. So if Swiggy also go for the IPO, anyone will be investing in that. But if the Zomato is not earning good, or it's not done properly, so and if a Swiggy go for the IPO, everybody will think that this it is the same line of business. So why should you invest in Swiggy? They will not be interested in buying the shares of the Swiggy, because Zomato is not working properly. Uh, and so they cannot raise the funds. But if Swiggy is their own management or financials are very much strong, they can they can have the faith in the customers, all the people, then they will be go for the IPO also. Focus normally in startups, there are no revenues in the initial stages, or there are operating losses because more amount is involved in research and technology part. So in a initial stage, there are less revenue generation. Focus on intangibles like business ideas are not taken into consideration or in some type of valuations. Success ratio, mostly the startups success is very questionable whether they will survive in near future or not. If suppose any startup is started right now, they will shut down in business in within a year or maybe next 2 years. So the success ratio is a very less. Success depends on management expertise, because management is very important in the startups. So if the management is proper, then they can easily mark their revenue. They will able to generate the revenue. Like example, Zomato recently brought a Make My CEO as a CEO. A constant innovation and scalability is very important in Zomato, in any startups. So like Zomato, basically they were only food rating app, but they later on they introduced various other services like a food delivery and table booking services. Depends on private equity. It depends on both funding and expertise. Means basically to get the funds from the investors is very much a big challenge for the startups. So the startups may have a different value by different values. There are lack of historical information. Forecasts are uncertain. So there are more lot of guesswork in the startups valuation. Basically multiple methods are there for the startups valuation. Normally startup valuation, there are these 9 methods for the valuation, like a book value method, cost to duplicate, DCF, first Chicago method. But to understand, normally when in actual practice, normally when anyone go for the valuation for the startups, they go for the DCF method. Or they if the very startup is in a very early stage, then they can go for the market multiple method, and even they can go for the venture capitalist method. But normally other three other methods are not used in the normal circumstances. But to know what are the other methods, one should know what are the other methods. So I would be discussing all the methods. Book value method. This method is based solely on the tangible assets of the company. So whatever the assets are available with the startup, like they are having their app, or they are having their computer, laptop, or furniture. So, or if they suppose they have 100 as an asset, and they are having a 30 as a liability. That for this startup they have a 30 as a liability. Then the value of the startup would be 100 minus 30, 70 will be the valuation. And there are 70, and there are 10 shares. So 7 per share would be the value of the organism, means pricing of the shares. So this basically this book value of method does not take into account any growth or revenue generation in future. So the method is not followed in day-to-day practice. Cost to duplicate method. Normally cost to duplicate method, like one would not be ready to incur extra cost for any since anybody would not be interested in paying more than what is actually required. Suppose if Zomato, like I want to make a same type of a startup like Byju's. So what would be the my cost for this? That I would want to hire some teachers. I want to have should have that type of technology. So whatever the cost they have incurred Byju's, I should be incurring the same type of cost, more or less, but not very much more than that. Suppose it costing is 1,000. I should maybe incurring 1,000 or 1,100, but not 2,000, 2,500. There should not be significant variation, because anybody would not be ready to pay much higher than the cost. So cost to duplicate means the same type of if I want to make the same type of duplicate means same type of startup, then there should not be any extra cost to be incurred. So, however, this method does not reflect the company future potential like a revenue generation. So, since I have told that there is no revenue generation in future, profit and return on investment, and does not capture tangibles like brand value, this method is not followed in a day-to-day practice. So, normally DCF method is followed. Suppose if you go for an evaluation to if you're having any startup and you go to a register value, then they would be valuing your startup based on the DCF method. So basically in DCF method, normally they would be requiring projections. Normally 5 years projections is taken from the management, like whatever the founder, co-founders, they have to provide the 5 years projections about this startup. They would be having right now. Suppose they are having 2 branches, they would be means widening their business in 7 other branches, and they would be employing a few more persons. So what would be the growth, or what will be the suppose they are dealing with any product, then what will be the product sale of that product. So they should provide all the projections that sales would be this much, and this would be the profit, and this would be the EBITDA, and this they so all the projections should be get from the management. And even the management has to tell the what were they if they are incurring any fixed assets expenditure on fixed asset, or any working capital investment, additional working capital investment is there, they have to provide that investment for the valuation. Normally, discount rate would be higher in case of the valuation of the startup. I would be taking an example so that it would be clear for you all to how the valuation is actually done. The purpose of this if analysis is to estimate and the money or investor how much. Normally in DCF method, we calculate from the projections. Since the projection is for 5 years, we first discount this projection to get the present value. So the first step would be the getting the present value. What is the present value of the startup? Like suppose this is an example. Suppose if there are 100 revenue in first year, next year is also 100, third year is also 100, but the money that I be getting 100 after 1 year, the value of that money will not be 100, because I would be getting after 1 year. So I have to discount that at the present value, because the money which I be getting after 3-4 years, that value of that money would be less than the value of the money right now. Suppose the value of 100 is 100 right now, but the value which 100 rupees I would be getting after 1 year, the value of that 100 would be less than 100, because I'm getting it after 1 year. So inflation, other factors are also taken into consideration. So we have to discount that 100 to get the present value. So this is a projection. So in this we have taken the discounted as 10 for example. So we have discounted this at 10. So 100 rupees which I am getting after 1 year, the value of 100 is 91 right now. And 100 which I would be getting after 2 years, the value would be 83 right now. So we have to first calculate the present value. And terminal value, since as I told earlier also that we expect that the business will be in future also. So we have calculated, we should calculate terminal value. By going concept valuation, we should take the terminal value as a base. So we have to calculate terminal value of the business, and we discount this also at a discount rate. So discount rate can be a cost of equity or weighted average cost of capital. Suppose there are in capital structure there is a debt element is there. Then one has to find out the weighted average cost of capital. Otherwise, the cost of equity is base for the discounting factor. Suppose we get the discounting factor as a 16. But for the valuation of startup, we take at a higher rate. So we add back 2 extra for a risk factor. So we discount at 18%. So here we discount at 10%. So we get the valuation as a 565 million. So the value of 100, which I would be getting after 1 year with 91, 83, like this, we have to do the valuation. So this is what we get the enterprise value. So DCF is a total enterprise value. Suppose there is a debt element is also there in the capital structure. So we have to deduct this debt element from this enterprise value. Enterprise value means available to all the stakeholders, like it is available to equity shareholders, debentures, or preference shareholders. So all stakeholders are involved in enterprise value. But when we calculate price per share, so we are mainly concerned with the equity shareholder. So we have to deduct the preference shareholder preference shareholder proportionate amount and debenture holders amount from this enterprise value. Then we get the equity value. And after getting the equity value, we divide by it by number of shares. So we get the price per share. So normally we in valuation report, in valuation we give price per share, or we give range of the valuation. Suppose we get the valuation as 45. Then we give the range that 10% here, 10% there. Suppose we give the range that the price should be 40 to 50. Like normally when any company is going for the IPO, they give the price band 72 to 70. Like Zomato was having a price band of 72 to 76. So normally range is given. Or either you can specify one value. That 75 is the value of the price of the shares. So any person who is ready to invest in such type of startup, he will suppose he is providing 75,000 amount to this startup. So price per share is 75 rupees. So he should get 1,000 shares of this startup. Then market multiple method. Since earlier also I have told that the market multiple method is a relative valuation market, since we take the other companies data as our basis for the valuation. Like we take equity multiples, like we take PV price earning ratio of other companies, if we are going for IT shares valuation, we take the price earning ratio of Infosys, TCS, Wipro. So if we take the average of this all this and we get the valuation of our company, then it is called as a market multiple method. So based on the other company's value factors, we do the valuation of our company. Or we can take a price to sales ratio. There are enterprise multiple methods, EV upon revenue or EV upon beta. Like if you have seen Shark Tank, they always ask what is the EBITDA of the company, what is the your gross margin ratio, what are your P ratio. So they analyze based on this multiples and they invest in such companies. But to find a similar type of companies, one should very much particular to find the same type of companies. Suppose I am valuing IT company, I should not go for the PE of the auto sector or anything else. So I should have the similar type of business or similar type of companies for the valuation. Since it is widely used and simple to operate, since it is very simple, sometimes it can be misleading also, because it is a relative valuation. So it is basically not depending upon the valuation of our own companies. So it can be a misleading also. Like this, suppose if we are valuing a beverage company, like the Coca-Cola company, we take the all the beverage companies like Coca-Cola company, PepsiCo, all this, we take the 5 to 6 companies of the same sectors. Then we get all these financials are available. There are various websites where these financials are available, like Money Control, BSC, NSC, Yahoo Finance. So one can easily collect the information from the various websites, and they can analyze what will be the price, EV upon sales, EV upon beta. So one, if after getting the all the calculation, they can do the average, and from this average they can do the valuation of the their own beverage startup. Then there is a first Chicago method. First Chicago method is a very much similar to DCF method. In this also the same. It is a extended form of DCF method, but in this there are 3 valuations given by the management, means of value. Like if the your startup whatever you has assumed, then the same circumstance has occurred, then normal case. But there can be a best scenario also, like your startup, suppose you have done valuation that 100 rupees valuation of shares, but your startup has worked very much good, that the price of per share is 200. Then there is a best case also. But if there is a your startup is not worked as per your assumption, then there is can be a worst case also. So there are this 3 type of uh, different situations can be there. So we have to assign the probabilities. Suppose if your startup worked as per your assumptions and projections, what will be the valuation? If you don't work as per your projection, then what will be the valuation of this startup? If it works best as more than expected, then what will be the valuation of this startup? Like if we take the example, like in normal case, the startup will have the 120 million as a valuation. But if we work, it works very much good, then it can go up to 180 million. But in case there is a downfall, then up to the startup can only have a 50 million as its valuation. So what are the probabilities of this valuation? There are base case is 60, upside case is 25%, downside case is 15%. So based on the probability, we form the valuation, like 120 to 60%, 180 to 25. So 124 will we get the valuation of the business. So in this, all the 3 scenarios are taken into consideration for the valuation. Then there is a main venture capitalist method. this can be better explained with the help of example. Like normally, if any type of a business is there, suppose in this type of example, suppose this PE investor want to invest in this IT company. He is having 4,000 million as a, he want to invest a 4,000 million. And he want a return of 40%. So how much share one should get? If he invest a 4,000 right now, and he thinks that I would be investing this 4,000 for 5 years, and I'm expecting a 40% return. So how much I should be getting the first of all, what should be my share in this organization first, and what is the valuation of this organization? So based on the like market multiple, EBITDA is given 5,000, a market multiple is given. So EBITDA of the other company is given. So we are doing the valuation, relative valuation. So 5,000 is our basis. 5,000 into 6, like we do the valuation like this. 5,000 into 6, since 5,000 was the EBITDA, 6 as a multiple, we get the enterprise value as 30,000. So, and cash and equivalent is given in the question that there is a cash available with the firm or startup 600, and there is a debt element. Since I already did, we are focusing only equity shareholders. What is the equity shareholders task? So we have to eliminate debentures, preference shareholders from the valuation, because valuation is basically we give valuation per share per equity shares. So we eliminated debt element from this and we get the equity value as 28,600. But this 28,600 is after 5 years. So what is the valuation as on date? So we have to discount this at 40%, since the required rate is 40%. So we discount this at 40% and we get the valuation as 5317. Since 28,600 we would be getting after 5 years. So what is the valuation of this organization right now? 5317. So 537 is the valuation right now. And if we invested 4,000, what was the before valuation? That is called as pre-money valuation and post-money valuation. That after investment of this 4,000, what is the valuation of the organization? 5317. And before investing this, what was the valuation of this organization? 1317. Since I'm investing 4,000 million and valuation of the organization is 5317. So 4,000 divided by 5317, I should be getting 75% share. So the one should know the what means if I invest 4,000 in this company, what should be my percentage share in this organization? For to know the how much would be my percentage share, I want to know the valuation first. So if I know the valuation, then only I can ask for the percentage. So normally this method is also used in the like in Shark Tank also. They first they calculate that this is would be the, so they ask what is the EBITDA, what is the margin. So they all this roughly do the calculation part, and they so invest that we should get a 5% share in this year. We are interested in 5% share of this company, and we should get this much at this amount, or we should get a 2% share, 3% share. So normally this is the calculation for how they ask the we should get a 4% share or 3% share. Then there are Marcus method. The Marcus method gives the range of values. As I told earlier, although we can give one value or a range of values. So if we give the range of values, this is based on the Marcus method is based on the sound idea. All these 5 factors: sound idea, prototype, quality, time management, management type, team, strategic relationship, product rollout. So all these 5 factors are the basis for the Marcus valuation. Then there is a scorecard valuation. Since like in Burkers, there was 5 elements in scorecard. There are 7 elements are there. Based on these 7 elements, we do the valuation. Like for team management, if the team of the startup is very good, we give 20, ranging from 20 to 30%. That we give 25 as a well for the team. Size of the opportunity, since opportunity is very good in this startup, we give 20 as the 20 or 22 as this for this startup. So based on this range assigned, we can give the value for the all the these factors, and we get the valuation of the startup. Like if the target company score is X, the assigned factor management team will be 0.3x. So the combination of all these 7 factors will be the valuation of the company or any startup. And last is the risk factor simulation method. Like in startup, there are various types of risks are involved in the startup. Like there can be a management risk if management is not proper, or a management retire. That like if it is a limited liability partnership, if any partnership partner resigns, or there is a death of any partner, then there can be a management risk. There can be a capital risk. If they are not getting funding properly in time, so there can be a capital risk. Technology risk. Suppose if you are working on a technology, one startup is on technology, but you take so much time in research and development that the technology go uh, out of market, or it is absolute. Like introduction of a digital cameras, the Kodak cameras have gone out of demand. So like if you're a manufacturer or business into business of Kodak cameras, then your business will be down. So one should know the what would be the technology risk involved in such type of. Suppose you are very much in a technology startup, then you should know what is the technology right now in the market, or what is the scope of this technology in future also. Like in right now, there are various startups on AI technology, or like this blockchain technology, because if they are in demand right now. So the various startups are there on blockchain technologies. Litigation risk, international risk, because suppose your startup is of any out of India, or it has international presence, then the various international risks are associated with this. Like if there is a war, like Ukraine war, or if there is a suppose like China, we have a like a stop importing from China, then all these international risks are involved in startups. Suppose you are in a plastic and there is a ban on plastic from the China, or any the molecules like the which is used for the manufacturing, then your startup will suffer. Like there is a ban on the like a laptop or computer parts right now. So any startup which is working on a um, introduction of a manufacturing, or any this laptop or a computer desktop, then it will be have a great future in, because there is an internet ban on the from the import of this. So all these 12 elements risk involved in this. So one should know the this what are the risks associated with their startups. So one should critically analyze their startup, and based on this, evaluation is done by the valuer. So and thank you for patient listening. If any questions are there, I can answer the same. If anyone has any doubts or any questions, or they want any repetition of any slide, I would be solving the same. Vaibhav,
Yes, ma'am. Thank you, ma'am. If anyone have any questions, you can unmute yourself and ask directly, or you can put in the chat box. I repeat, if anyone have any questions, you can unmute yourself or you can put in the chat box.
they can put on chat box also.
Ma'am, there are one question from Hari sir. Sorry, ma'am. A very good
Very
presentation
good
and
presentation and nice
yeah,
speech.
yeah. Not
Thank
sure.
you,
Yeah.
Harish.
So I think there is no more questions, ma'am. So we move ahead. Ma'am, I request you to please stop sharing, ma'am, so I can share from my side.
Yeah, I'm stopping the sharing. Yeah, Sahil, one question is there. You can unmute yourself or you write in case of pre-revenue. What is your question? You can unmute yourself or write in chat box.
Hello. Um, Hello, ma'am. Thank you. Thank you for a very informative presentation.
Thank you.
Actually, I was in a noisy area, so was hesitant to unmute. So my question was that in case of pre-revenue startups, uh, when pricing of the offering is also tentative, can discounted cash flow be relied upon?
No, in case of a pre-revenue startups, one can mostly rely on a market valuation. Market multiple valuation would be better because right
Okay,
now the projection cannot be very much certain. But after suppose after 1 year or 2 years, they have started earning properly, and one
right,
can be very much assured that the same revenue would be generated in future also. One can go for the DCF method, and the one can go for the projection, and DCF method can be applied based on that.
right. Thank you, ma'am. Thank you. That was a doubt I had. Thank you.
Yeah, it's okay. I hope I clear your doubt.
Yes, ma'am. Thank you so
Yeah.
much.
Any more questions?
So thank you, ma'am, for your presentation and explaining topic in simplifying way. Our next session is on 26th August. ICS is pleased to provide you all its research and development, integrated management system, QMS, EMS, and OHSS, excellence in education management, ISO made easy in Gujarati, Marathi, Telugu, and Hindi. For reading any of the above book, please contact Ms. Sushma Tindalkar on the given number. Feedback form. Please register on www.sadgunsang.org and go in your login and give your feedback. Thank you, Nirmala ma'am, and thank you all the delegates and participants who were joined for the today's Sadgun Sang. Now it's time to officially close the session. Thank you, ma'am. Thank you, everyone.
Thank you.